The Federal Reserve Bank just finished meeting and they announced yesterday that number one, inflation is falling. Number two, they're not going to cut interest rates today. And number three, you might see an interest rate cut starting this September. So if you have a mortgage, if you have a car loan, don't hold your rates too tight because the Federal Reserve Bank hinted for the first time that we might be seeing interest rate cuts coming soon. So what is happening here? Well, the Federal Reserve Bank is the central bank here in the United States. They have the ability to either A, cut interest rates, B, raise interest rates, C, keep interest rates the same, and they also have the ability to print money or remove some money from an economic system. That's called quantitative easing and quantitative tightening. And obviously, these factors play an impact on people's finances. I mean, higher interest rates mean that your mortgage is more expensive, your car payment is more expensive. If you have credit card debt, that becomes more expensive. And so a lot of people have been keeping their eyes on what the Federal Reserve Bank is doing. And the Federal Reserve Bank follows what's called a dual mandate in the United States. What that means is they have to look at two different factors when they make their decisions. Number one, they look at price stability. Number two, they look at maximum employment. These are just fancy ways of saying, number one, they're looking at inflation. Number two, they're looking at unemployment numbers. Based off of these two things, inflation and employment numbers, they decide what to do with interest rates and they decide what to do with money printing. That's what they have the ability to do as a central bank. Well, the thing that everybody in America has kept their eye on is what is the Federal Reserve Bank going to do with interest rates, because these interest rates not only affect regular people with your mortgage rates and car loan rates, but they also affect businesses because businesses don't get 30-year loans. They have shorter term loans and we have a lot of debt coming due in 2024 and 2025 because every business was refinancing in 2020 and 2021 when interest rates were at the lowest rates ever. And now that these debts are starting to readjust, businesses are sitting at the edge of their seats hoping and praying that the Federal Reserve Bank is going to cut interest rates. Commercial landlords are in the same boat because their loans are getting ready to readjust this year and next year. So they're wondering what is the Federal Reserve Bank is going to do. And the government is also keeping an eye on this because the government also doesn't just have 30-year loans. They have shorter term loans. And as interest rates stay high, the government has to spend more tax dollars paying down interest. And of course, 2024 is an election year, so you bet that everybody is watching what the Federal Reserve Bank is going to do. And for the first time, we got some indication as to when the Federal Reserve Bank might seriously consider cutting interest rates. So what I want to do is break down all of this, what's going on with the Fed, what they said yesterday, and what to expect. So let's jump into all of that. But first, a quick reminder that on August 14th and 15th this year, I am hosting our biggest wealth building workshop of the year. It's a live virtual workshop. It's our investor summit where I go over, number one, how our money has changed from August 15th, 1971 until now, because that was when the dollar was taken off the gold standard. Number two, how you can build wealth in this changing economy, because of course, money has changed. Our economy has changed. Investment opportunities have changed. Interest rates have gone up. Inflation is still around. Unemployment is starting to go up. How can you find investment opportunities, find financial trends, and find wealth building opportunities in this economy? That's what I'm going to be going over in this workshop. It's completely free. I would love for you to join. We're having two different times, one on August 14th and one on August 15th. So if you'd like to join, all you got to do is register. I got the link for you down in the description below. So let me start by reading directly what Jerome Powell, who's the chairman of the Federal Reserve Bank, said in this most recent meeting. He said, quote, "We think the time is coming." What time? Interest rate cut time. What he says is that there's now a, quote, "overwhelming sense from his colleagues that there could be a case for an interest rate cut as soon as the next meeting, which is September 17th and September 18th, 2024. And when the Federal Reserve Bank is making this decision on what to do with interest rates, remember, they're looking at price stability, which is inflation, and they're looking at unemployment numbers. Well, what the Federal Reserve Bank is saying is that we're finally starting to see a gradual progress towards 2% inflation, because the Federal Reserve Bank has set this target of 2% inflation. This is an arbitrary number that they came up with, that they want to see 2% inflation. Why is it not 2.5% inflation? Why not 3% inflation? Or why not 0% inflation? Why not -1 or 5% inflation? Well, it's just the number that the Federal Reserve Bank picked. And so they want to see inflation come down to 2%. And if that happens, they would consider this inflation fight a win. And we're not at 2%. CPI today is around 3.3%. Inflation is at 3.3%. But what the Federal Reserve Bank is now saying is that they don't need to see 2% inflation to start cutting interest rates. What they want to see is progress towards 2% inflation. They want to have confidence that inflation is going to fall to 2%, and that will give them enough confidence to then cut interest rates. So it's a little bit of a different tone because 6 months ago, the Federal Reserve Bank said that we're not cutting interest rates until we see 2% inflation. Today, it's we'll cut interest rates if we're confident we're heading towards 2% inflation. Now, what I want you to understand about this from a financial education standpoint, because this is something that I think many people don't really understand, is why 2% and what does 2% inflation actually mean? Because 2% inflation does not mean that grocery prices are going to fall. 2% inflation means that the prices of things keep rising. They just don't rise as fast as they were rising before. See, inflation compounds. The inflation that we're seeing today in 2024 is on top of the inflation that we saw in 2023. It's on top of the inflation that we saw in 2022. It's on top of the inflation that we saw in 2021. And the reason why this matters is because we have a lot of news talking about how incomes are rising faster than inflation today. This is what a lot of media agencies are saying, which is true to an extent. If you look at the reported inflation numbers and the reported payroll numbers, you'll see that today, incomes on average are rising faster than the inflation numbers, which is good news. The problem is if we look at the last 5 years, or even the last 50 years, but we'll focus on the last 5 years, inflation significantly outpaced wages. And so now, if you see incomes slightly growing faster than inflation today, versus for the last 5 years, inflation was significantly outpacing wages, that still means that people are a lot more struggling today. People are poorer today than they were back in 2019 because inflation has been growing faster than people's incomes. Not to mention the fact that reported inflation is not the real inflation that the average person sees. Reported inflation says that grocery prices have grown by around 25% over the last 5 years. I don't know any person that has seen their grocery bill grow by only 25%. So there's a difference between number one, reported inflation, and number two, when people say income is growing faster than inflation, well, what does that actually mean? And so these are the things that I want you to understand because, well, sometimes the reported data gives you a skewed image of what is actually happening. So the Federal Reserve Bank is now talking about potentially cutting interest rates in September. Jerome Powell said, quote, "I think a rate cut could be on the table in September because in recent months there has been some further progress towards the committee's 2% inflation objective." So we kind of established this, that the Federal Reserve Bank is now saying for the first time that there's a good chance that we could see inflation continue down the way that it is now. And if it does, then the Federal Reserve Bank will cut interest rates in September. Of course, things could change between now and then, but it looks like that is on their mind to ideally cut interest rates in September. Now, there's two things that I want to talk about this. Number one is, well, what does this have to do with an election and how does this impact you? And let me start by talking about the election because, of course, we have an election come November. Now, I don't care if you're a Democrat. I don't care if you're a Republican. You're both probably going to hate me for what I say, but I don't make videos to get you to like me. I make videos to help you be better with your money. The reality is, if the Federal Reserve Bank cuts interest rates in September, what's going to happen is Democrats will be happy. Republicans are going to say, this was a political plot to start cutting interest rates, to start stimulating the economy right before the election as a way to buy votes. That's what's going to happen. If they don't cut interest rates, the Democrats are going to say the Federal Reserve Bank is being manipulated by the Republicans because they don't want to cut interest rates as a way to stifle the economy right before the election. So just understand that there's going to be political agendas on both sides because both parties want to win. Democrats want to win. Republicans want to win. I just want you to understand the political mindset behind this. But at the end of the day, the Federal Reserve Bank is supposed to, keyword, supposed to be an independent entity. It's called the Federal Reserve Bank, but if you go to the Federal Reserve Bank website, they will tell you it is not a federal entity. They're not a part of the federal government. They are an independent entity. They're supposed to be. So they're not supposed to be manipulated by what's happening in the government. Although sometimes that does happen, but that's what it's supposed to be. They're supposed to be an independent organization. Now that we've established that, let's talk about what this means. Because from a practical matter, if the Federal Reserve Bank starts cutting interest rates in a couple of months, what does that mean? Well, practically what that means is that the banks, the banking system would be able to borrow money cheaper. That's what lower interest rates mean. Because when the Fed cuts interest rates, that doesn't mean that your mortgage rate is cheaper per se. What that means is that banks get to borrow money for cheaper. And if banks have a lower cost on their money, then they can pass those savings on to you when you get a mortgage or a credit card or a home equity line of credit. You could think of it like the wholesale interest rate that banks pay to borrow money, right? Banks have a cost to borrow money. That's the Federal Reserve Bank rate, the federal funds rate. That's what it's called. When the Federal Reserve Bank cuts this federal funds rate, that means the bank's cost to borrow money falls. And if the banks pay less money to borrow money, then they can charge you less money for your mortgage. They can charge you less money for your credit card debt. So if you're thinking about buying a home, at first glance, that's great news because now potentially you'd be able to get a cheaper mortgage. But that doesn't give you the full story. Because now let's play the scenario out. If mortgage rates fall, what do you think would happen? Well, it looks like, based off of the data, there's a lot of potential buyers who want to buy a home that are sitting on the sidelines because they said home prices have gone up too much. The housing market is too crazy. There's not enough homes on the market. I've been overbid on too many homes. I'm just going to chill out for a little bit. I'll rent one more year. There's a lot of potential home buyers that have decided to just kind of put a pause on their home buying decisions. Well, if mortgage rates start falling, what would happen? I mean, I'm just a random guy on YouTube. Okay, let me make sure I reiterate that. I'm not a financial advisor. I'm a random guy on YouTube. I'm in my hotel room in Manhattan right now because I'm doing some work here in New York. I'm a random guy. But what could happen is if the Federal Reserve Bank starts cutting interest rates, your broke cousin Bunty might say, oh, mortgages are a little bit cheaper. This might be a good time for me to go look for a home. And if your cousin, my cousin, and everybody else's cousin starts to look for a home, that could mean more people are looking to buy a home. And if more people start to bid on homes, then you could start to see more bidding wars because we just broke a new record high in home prices. And we also still have a very low inventory of homes available for sale. Although it is higher today than what it was 12 months ago, we still have a very low inventory of homes. So if more people start to enter the housing market to buy, that could push home prices up even more. So sure, yeah, your mortgage rate, interest rate that you're paying could be a little bit lower, but you might have to borrow more dollars if home prices start to go up. It's the same thing in the business world and the commercial real estate world that I want you to pay attention to. The reason why nearly every corporation and nearly every corporate landlord in America has been pressuring the Federal Reserve Bank to cut interest rates is because corporations and commercial landlords don't get 30-year fixed-rate mortgages. They get 5-year readjusting loans, 4-year, 3-year readjusting loans, 7-year readjusting loans. And nearly every one of those same corporations and commercial landlords refinanced their mortgages in 2020 or 2021 when interest rates were at their lowest levels ever in the history of America. And so what happened? Every corporation borrowed as much money as many dollars as possible at the lowest interest rates possible. And now these debts are starting to readjust. They're starting to readjust in 2024. We're going to see even more readjustments in 2025, which means if you're a business or a commercial landlord, your cost of doing business is going to go up. Not just because of inflation, not just because your employees want higher salaries. It's because your cost of servicing the debt that you have is going to readjust at twice what you were paying before. Now, normally in a normal time, what you would do, whether you're a commercial landlord or whether you are a business, is you're going to pass that cost down to your consumers. So if you are an office landlord, you would tell your office tenants, your rent is going up. If you are a business, you would raise the prices. But we've already seen what's been happening with inflation, and we know that businesses are not seeing the same growth as they were in 2021. At least most businesses are not. Some businesses are, but a lot of businesses are not. And so if you're a business or a commercial landlord and you can't pass this additional cost down to your consumers, because consumers can't keep absorbing these higher costs because inflation is burning a hole in a lot of people's pockets, then what do? This is why many businesses have been concerned, because they know the cost of these higher interest rates. They know the cost of these debts readjusting, and they don't want to have to pay those costs, because that means that more businesses are going to fail. More businesses would have to declare bankruptcy. More commercial real estate landlords would have to declare foreclosure. I mean, we've been seeing a lot of bankruptcies happen. If you don't believe me, I want you to Google how many bankruptcies have happened in 2024 and compared to the number of bankruptcies that happened during the 2008 recession. I'm not going to say it here. Go and Google it. That way you can see for yourself the bankruptcies that have been happening, because a lot of people just haven't been covering it. But this is something you want to be aware of, because these higher interest rates have an impact. And so this is why the National Association of Realtors, the Mortgage Bankers Association, they have written letters to the Federal Reserve Bank begging them to start cutting interest rates, because that will save the business. But the risk is, if the Federal Reserve Bank starts cutting interest rates, it could make the inflation problem worse. And this is something you want to pay attention to as an investor, as a financially educated person, because who does inflation benefit? It doesn't benefit consumers, it benefits investors. And you want to make sure you can win no matter what happens. You want to make sure you can win whether the economy is booming, whether the economy is crashing. You want to make sure you can win whether inflation is hot, whether inflation is not hot. And the way that you do that is by becoming financially educated, working to understand the financial trends, and working to be prepared that way you can capitalize on investment opportunities. That's why I make these videos. I want you to understand what's happening, because unfortunately, most of us have no idea. And it's confusing. There's a lot of complex things happening out there, but you have to understand this, because every single person uses money, but most people have no idea of how money works or how our economic system works. But if you don't understand this, you become a pawn in the system. And I want you to be somebody who can build wealth in the system, because well, the system is designed to create wealth, but the only people that can create wealth are the people that understand how our economic system works. So I'll be going a lot deeper into this in my Investor Summit. It's a free workshop. I got the link for you down in the description. And of course, if you want to stay up to date on what is happening in the financial markets, when it's happening, you can join my free newsletter called Market Briefs. We cover what's happening in the markets in our free newsletter every morning. I got that link for you down in the description as well. And with that, tomorrow I'm going to be talking about what's happening in the jobs market, because we got some very, very interesting data in the jobs market that I'm going to cover tomorrow, because that would make this video way too long.